Let's jump into the reason we had Brian on with us for this discussion. We're going to talk a little bit about the markets. And, Brian, I don't know about you, but the whole Robinhood thing has been on the news a lot with GameStop and all their activity that, the way that we talked about that. I think it was last week, maybe the week before. We were talking about the impact of the short squeeze and the difference, the little guy getting the investments going, pushing those values higher, and they went astronomically higher. And some of the risks of all that we talked about. All that being said, in the aftermath or in the midst of that, one of the do-it-yourselfer sites that allows people to get, maybe small investors to get access to individual stocks without charge, I believe, is Robinhood. And it's essentially a platform that investors can use. And at one point, they stopped trading GameStop. And it became quite controversial and perhaps a lot of bad press for Robinhood in that process. I think it's been painted as some kind of an evil endeavor, where they were trying to screw the little guy, which is really not their mantra. They're all about the little guy. But would you care to elaborate on what's your take on this and how should people think about this whole issue and what to make of it?
I think there's certainly things to be skeptical of and look further into, which I think a lot of people have done a great job of pointing out. Melvin Capital, for example, is one of the large hedge funds which was taking it on the chin as GameStop stock started rising, and they were heavily short the position. And Citadel, which is a big financial broker and funder of a lot of hedge funds, bailed out Melvin. Now, this was controversial because Citadel is the big customer of Robinhood. The reason why the trades are...
And there's some distinction between Citadel, the hedge fund company, and Citadel, the broker-dealer, and I don't know the distinctions between them, but there's two distinct entities.
Okay. So Citadel, they pay Robinhood for the order flow, and then they make the market. So that's how Robinhood provides quote-unquote free trading, is because they're getting, for your trade, Citadel is paying for the right to execute your trade, and they're taking a bid-ask spread. So it should be noted that it's not really free trading. There is still going to be a bid-ask spread. And in the case of Robinhood, the bid-ask spreads are wider than they are for any other brokerage house. So they're not necessarily free, and there was this conflict of interest between Citadel and Melvin Capital, which has been pointed out, from on various podcasts and news sites and social media outlets. Now, whether or not this was nefarious activity is another question. I think that remains to be seen and could be litigated in court. I don't really think it's in Citadel's best interest to have bailed out Melvin Capital. It definitely doesn't look, the optics are poor for sure on that front. So that was maybe the thing that there will be lawsuits and hearings about for sure.
There's already been put out there as a class action, I think, or 1,000 or so.
Yeah, you could argue that limiting the trading sent GameStop down for a day, which helped hedge funds like Melvin Capital cover their shorts, which helped funds like Citadel fund hedge funds like Melvin.
But it sounds like the real issue was they just didn't have the capital requirements to meet the obligations of being able to trade more in that stock than they already had, correct?
Yeah, so the other story that seems definitely plausible. I don't want to dismiss the nefarious one, because I think it could have, it's definitely a conflict of interest there for sure that needs to be explored. But the one thing that seems clear on why they limited the trading is because of the structure of the market and how clearinghouses work. when you make a trade, it takes 2 days to settle. So you can make the trade and you effectively legally own the shares. But the money doesn't actually change hands for 2 days through DTCC, the Deposit Trust Clearing Corporation is what I believe it stands for. And the DTC can essentially make sure they can essentially do a margin call on the brokerage firm. So if they believe that the brokerage firm isn't going to be able to cover have the dollars for the trade based on the activity in their clients' accounts, they can make them post margin, which is what the DTC did. They essentially forced Robinhood to have enough capital to meet same-day settlements requirements. So Robinhood went out and they raised $3.5 billion over a couple of days through debt and equity to meet this margin call. And that's the reason why they're saying that they limited trading. It should be noted that they're not the only brokerage house that limited trading. Interactive Brokers did for sure. I believe some of the larger houses did too, but maybe to a lesser degree. But Robinhood was definitely the story because, like Chris said, these are primarily retail investors who presumably were the ones pushing up the stock in the first place.